Hello, everyone. Welcome, and thank you so much for being here today. My name is Adriana Salazar. I'm a managing director at Cowen. Really excited to be here and to share with you Cowen's commitment to CMU and to the Short Center for Entrepreneurship. We joined as a patron sponsor about a year ago and have developed a really close partnership with the school and with the center. And we're excited to be able to offer a little bit about what we do at Cowen. For your benefit, Cowen is an investment bank with full service opportunities in sales and trading, investment banking, research, and asset management. And today I'd like to introduce a colleague who is at the center of one of the new and growing spaces within our firm, which is digital assets. So I'm very excited to have him speak with you all. And to the extent you have any questions, he and I would both be available and happy to share a little bit about Cowen and also what we're seeing in the market as it relates to digital assets. So with that, I'll turn it over to my colleague, David. Thank you again.
Hello, everybody. My name is David, and here's the presentation that I gotta give credit to an analyst, Rishi. He did a lot of the heavy lifting on it. So with that said, feel free every couple of slides. I'll just take a pause. If anyone has any questions, I'm happy to dive into specifics. Otherwise, let's get started. Cowen Digital. It's been in progress for about 15 months prior to me joining, which was in March of this year. We had the official launch. It's based in Stamford, Connecticut, with the new division offering full execution and custody trade services. It's a white glove service. So what currently exists in the marketplace on the crypto native side of things is typically execution only, and they're trying to play catch up to what TradFi, traditional finance services have offered in asset classes that have been around for decades. So Cowen Digital is really unique in the sense that it's a TradFi. It's TradFi backed by Cowen, but it's a subsidiary of Cowen, so being Cowen Digital, and we actually offer a variety of things that we think is a unique advantage in the marketplace. Things such as aggregated liquidity, through one trusted counterparty, proprietary algorithms that were derived from the equities business and then built specifically to cater to digital assets and cryptocurrencies, streamlined operational and capital efficiencies, cold storage solutions. So what's interesting about Cowen Digital is that we've done proprietary investment rounds with strategic partners. For example, one of them being PolySign Standard Custody, which is co-founded by Arthur Brito, who is one of the co-founders of Ripple, the payment protocol. And so they built this really cool system for custodianship at an institutional grade level. Additionally, they even went out and raised capital to then buy MG Stover, which is a fund administrator. So when you think about like Cowen Digital's entire suite of offerings, you've got fund admin, custodianship, execution, and then on my side, the analysis and research, as well as cap intro for funds raising capital. This is that white glove service I had mentioned where we really do a lot of things beyond just like, oh, we'll execute a trade for you in that regard. So with that said, this is only possible because Cowen got buy-in from the top. Jeff Solomon, our CEO, has been fully supportive of the initiative, believes that blockchain technology is going to change the future and will drive innovation and investments for the years to come. And Dan Charney, co-president of Cowen, I have quotes from them both on the left, saying Cowen Digital provides our institutional client base with the same dedicated level of thought leadership, product capability, service, and professionalism they've come to expect from Cowen. So really, what that means is that people are familiar with expectations on the TradFi side when trading equities. They expect a certain level of service, which is not yet fully accustomed to the digital asset side, and that's what Cowen Digital is offering, to be that bridge between the two things. One of my coworkers always says, these bringing crypto degen spirit to TradFi rigor, which I find very funny just because in the crypto space, people refer to themselves as degens, figuring out the technology and investing heavily, which I think speaks to the collaboration and spirit of the nature of blockchain technology at a high level. Additionally, as mentioned, I started my background started in venture capital at seed stage investment, focusing on innovative technology like AI and robotics. And from there, during my time period there, I started learning about alternative data when modeling out public companies. And from that point on, I started teaching myself programming, which brought me into more alternative data, which brought me to Piper Sandler, which is another investment bank where I was an equity research data scientist for 5 years. During that time, I was working on equities during the day and crypto at night. And I ended up finding myself enjoying crypto significantly more just because it's so new still that you could find metrics and you can find alternative data sets that analyze and evaluate these protocols that no one has looked at before. No one's thought about dividing one metric by another and multiplying it by something to create something entirely new, feature engineering, right? So with that, I was like, okay, I've got to really transition to a role that enables my love for blockchain and digital assets, which is how I got involved with Cowen Digital. My role now does a few different things. One is which I help clients understand blockchain, right? It's a new technology stack and not everyone's familiar with the technology. So one of my roles is to be able to explain it in layman's terms, how it works, why it's interesting, and why it could change the future. And that usually involves things like understand the technology stack as well as the tokenomics behind certain protocols, the use cases, on-chain metrics, things of that nature, or you can really kind of dig in and use the data science skills that I've learned over years to start applying and being able to speak to it. But that's just on one side of the spectrum, which is more traditionally on the TradFi side. We also have crypto native clients that likely know more than I do in lots of different topics. And so they just want to, bounce ideas off me. For example, things like, what about layer 2 scaling solutions, Polygon versus Arbitrum versus Optimism, and how it's a race to the bottom on fees on ZK rollers. Now, if what I just said made no sense to you, that's absolutely fine. It probably made no sense to a lot of people, but that's on some level the intricacy behind the technology stack that people are trying to explore, which provides lots of opportunity for those looking to get into this space and get involved. I'll pause there for a quick question, or if there are any, otherwise I'll keep moving along. Great. So leading global companies are making substantial investments in blockchain technology and digital assets. So on your left, there are a bunch of companies listed here with the amount of capital they've invested, different number of rounds, and blockchain companies they invested in. Blockchain companies they've invested in range from exchanges to custodianships to NFT platforms to anything that is interesting and innovative in the space. They've at least looked at it and are likely investing it in one form or another. A lot of these companies represented here are financial or big tech firms, but as the next slide will demonstrate, there are tons of companies looking at the space that aren't a part of finance or tech. So those that are looking to get into the field, there are opportunity if that is not your bread and butter, so to speak. But I also like to just highlight that, Alphabet being Google's parent company, has invested over $1.5 billion with multiple rounds. Blockchain adoption is growing among the world's largest companies. So here we have a variety of companies, a lot of them Fortune 500, using a variety of different blockchains, some of which you may be familiar with, like Bitcoin and or Ethereum, and then some which you may not be familiar with, like Hyperledger Fabric and Quorum, which are enterprise blockchains. In 2019, Coca-Cola began using an enterprise Ethereum blockchain platform to enhance transparency and minimize friction in supply chain transactions. So I'll touch on this later as well, but basically what that means is in supply chain, there are multiple systems of trust or parties of trust that you go through to get your end product that you can pick up in a Walmart or Target. And there are certain standards that these companies want to adhere to, and blockchain helps enable the validation process in a trustless way of verifying this is where this product came from, it was sourced ethically or whatever standard that you're okay with. And then it went from X location to Y location to our final store. Therefore, it was refrigerated correctly. And it only took 4 months to get to our store versus 8 months. And when we were told it only takes 2 months, right? Like there's so many nuanced things to begin to even looking into supply chain like this And immediately you might be asking, well, how does all that work? Besides smart contracts, there are data oracles. I don't want to get too into the weeds because I will, but there are data oracles that will feed this information to these smart contracts so you can track this in a reliable way. Additionally, there are other companies like JP Morgan and Visa exploring the space, investing, and then Burberry collaborated with IBM in October 2020 on a blockchain-based product tracing system, The Voyage, that gives consumers insights into clothing's life cycle. Again, a similar concept where you're exploring how products reach consumers and what way they get to them and the pricing of all that. Like the optionality is quite limitless until data feeds until you get a lot of data feeds involved, and there's some complications. But really, the point of this slide is that there are tons of companies actively exploring the space and making investment rounds in the space. Which brings me to careers in blockchain and digital assets. For those, yeah. Is this better? Hello. I'm afraid to fiddle with this.
Yeah, that's.
Oh, sorry. Thank you. Hello. Thank you for telling me at least towards the beginning instead of the end. That would have been fun. So I guess to just quickly recap, lots of companies are investing. There are a lot of sectors investing and involved in the space. I've talked with lots of these companies as well, so I'm happy to dive into specifics if you're curious about some. But in the meantime, I'll continue on with the careers in blockchain and digital assets. So what's great about blockchain, as some of you may know, is that it's a very collaborative space. People like to share information. They like to share their best resources, unlike on the TradFi side, where if I found a data source when I was looking at equities, I'd covet it and make sure no one knew about it, because once someone else knew about it, everyone knew about it, and then there was no output to be generated from that data set. And I love blockchain for that reason. Everyone's trying to lift each other up. The mantra, like a rising tide lifts all boats, is really real. And so why I bring this up is that there are multiple like Google Sheets that demonstrate where people put in their own information about what careers they have, the time allocation and requirement of said careers, the technical capabilities, and what a lot of people coming out of college or looking at new careers are focused on is pay. So with that said, we took a couple of these spreadsheets, which had about 300 to 400 rows of jobs in the space, and analyzed it and broke it down to the slide here. So technical career paths: blockchain developer, architects, project managers, and UX developers. Other tracks: investments, 38% of hedge funds are investing in digital assets. Legal, we had 200 openings on Indeed, and consulting with 107,000 median annual salary. I would also add there are jobs not technical, such as, and we're going to get into the weeds a little bit here again, but like NFT project manager, communications lead. There are lots of roles that are being developed and invented right now in this space, where if you like to be more on the social media side, communication side, or some mix of the two, things are being invented for that role, which is really exciting. And I think it's fun to get involved. It can start as basic as like a Discord channel, which is, if you're not familiar, kind of like a Skype, but there's a blog inside, or a forum inside of it. Otherwise, otherwise the technology stacks are really interesting as well. Continuing on with the skills needed: Solidity, which is a smart contract programming language commonly used on Ethereum or EVMs, Ethereum virtual machines. It's heavily influenced by JavaScript, Python, and C++. What's cool about this, if you're a non-programmer and you think, well, that's out of my reach, is that Solidity is, relative to other programming languages, is really new. So it doesn't take much, call it 3 to 6 months of practice, to be capable to get a job using Solidity. I mean, Granted, you have to be really committed, but there's no like dev that has 20+ years of experience in Solidity like you would find in C++. Therefore, the opportunity set for anyone learning these skills is really wide, represented in the key statistic. I'll just read it quickly. $91,000 average salary, with top 10% earning $165,000 per year. Solidity developers earned as high as $500,000 in 2022 due to a lack of supply of talent. Everyone wants to get in blockchain, both entrepreneurs and big corporations, and there's just not enough talent in the Solidity dev pool to accommodate everyone's wants and needs. Therefore, demand and salary goes up, right? 44,000 listed jobs on LinkedIn. We're searching for blockchain worldwide, and blockchain/digital asset talent is needed by enterprises and government organizations. We've touched on the enterprises, both public and private. I'll also touch on government organizations later on. Lastly, the graph on the Google Trends analysis slide shows search interest. Simple enough on Solidity, Web3, and software development. You see it spike. I see the dates were cut off. You see it spike basically in the 2020 and 2021, with that huge spike being in 2021, demonstrating huge amounts of interest and understanding of what is not only Solidity, but Web3. And at a high level, Web3 is still loosely being defined. It shifts, and then there's even talks of Web5, but that's another conversation. Web3 is basically, if I had to define it, is where you own your own data. Many of you are familiar with Web2, which is like the internet that we use now, where if you go on Google, Google tracks all your cookies, knows what you're looking into, and will use machine learning to advertise things that you may not even know you want. With Web3, you own all your data, which is possible through tracking on the blockchain, and you can kind of use like zero knowledge proofs, again, getting into the technical side of things, but you can prove and give data without having to completely like expose yourself, which is really an interesting value proposition. And I would encourage anyone to kind of explore it, because again, it's one of the really cutting edge side of things that companies are heavily investing in. I can't stress that enough, that major companies are trying to figure out how to be involved with Web3. So with that said, I'll move forward. Any questions on that? Great. Bring it back to Cowen Digital here for a second here. Publications. Cowen Digital, on the research side that I lead, does a lot. Like every Monday we put out sales commentary, which highlights what's going on in the markets over the weekend and over the past week, as well as what transactions and volume we've kind of been seeing, things that might be interesting. Thursday, we put out a thematic piece that basically I choose what I think is interesting for the week. A lot of the past month, it's been the Ethereum merge and the switch from proof of work to proof of stake. But that also can be things like I wrote about ApeCoin when the Bored Ape Yacht Club, which is an NFT collection, launched their ApeCoin and ApeDAO, and people are very opinionated on NFTs, which I'm happy to dive into as well. Where one side thinks it's just a virtual image JPEG that you can right-click, save as, and now it's theirs, and another the other camp thinks it's representation of digital ownership on a blockchain. We also put out deep dives. For example, we put out deep dives on Avalanche, Polygon, and Ethereum, and taking from the TradFi side, when typically on the TradFi side, when an analyst published a report, they would accompany it with corporate access, which means if you publish on XYZ company, then you would bring in XYZ's management to talk with the investors as well to get more insight into the company. We tried to do something similar. We tried to duplicate that process. So with Avalanche, we brought in John Wu from Ava Labs to speak with our investors and talk about the report. With Polygon Matic, we had Sandeep, co-founder of Polygon, come in and speak. And then most recently, we had Raul Paul come in and speak about the Ethereum merge. And an interesting takeaway from that most recently was that he thought with Ethereum switching to proof of stake, the staking yield that Ethereum will provide will be, I'm going to air quote this, risk-free, because nothing in crypto is risk-free, but relative to other digital assets, it'll be the risk-free interest rate, so that other protocols offering staking yield will have to at least be higher than Ethereum. Otherwise, the risk profile wouldn't make sense to invest in, which I thought is a really interesting take. Additionally, we have two other analysts, Jarrett Seberg, who covers regulation on the Washington side. That includes everything crypto regulation, because that comes out, seems like something's coming out once every 12 hours. And then Stephen Agola, who covers the crypto Bitcoin mining companies that are publicly traded. And they are both phenomenal, which is why, again, the research offering that Cowen Digital has is so amazing, is that we have mining, public companies, we have Washington regulation, and then we have me on the protocol/analysis side. All right. The fun parts, technology innovations and opportunities. I talk a lot about finance and blockchain because I am most comfortable talking about finance. It's my background. But I realize not everyone cares about finance, and that's one of the unfortunate stigmas that blockchain has, is that, oh, it's only finance, so it's economics related. You have to enjoy technology to really be involved. And while some of those aspects hold true, I do think other sectors in blockchain are overshadowed, and I hope that, you know, even just highlighting them here today will spark inspiration or begin a dialogue involving them. So going into that, healthcare, automated smart contracts, other technologies enable greater security and accuracy of information while accelerating back office operations. So there's kind of two parts to that. One is automated smart contracts. There's a lot of paperwork and processes in big companies that eat up lots of resources and time by people, whether it's a checks and balances process where you have to have one person sign off to have another person to sign off, etc., or things getting shuffled in email and then getting lost because you get 100 emails a day, right? There are tons of reasons why automating some of this process would be super efficient. And that's where the smart contracts come in, is that you have two data feeds piping in and being like, hey, this has been approved. Let's do all the necessary steps to get it to the end step instead of having someone check it off each step of the way. In addition, when you introduce humans to a system like that, you open up error. So like on the healthcare side, like if you go to a doctor and you have your healthcare information, which is protected by HIPAA, and you then need to go to the hospital, there are systems in place to protect your data, but a lot of it does have manual steps along the way. And the last thing you want is your healthcare information having a misentry or someone losing something critical to the files along the way of transferring your information. And that's one of the other things that like blockchain could really help reduce the friction on, is that, as people may have heard, blockchain is trustless, where you don't have to worry about your other party as long as the information and basically the agreement in the smart contract is agreed upon, it'll send it over. So again, I'm going over high level, but I feel like at least you begin to see the process of where smart contracts would really help automate the systems and increase efficiency that way. Real estate, fraud detection, and this can apply to a variety of things. And I'll explain a couple of examples. And fractionalized ownership can result in real estate transactions taking just minutes rather than days to close. Recently, I was involved in a real estate transaction. My goodness, is it frustrating. I'm paying like $300 for one person to look over one piece of paper that's public government information. Like that doesn't seem right. I don't know. It's so frustrating. And so with smart contracts, it kind of touches on the automation side of things again, but like having this information on a callable database where you can just query it and send it over instead of having someone manually have to spend maybe it did take them 5 hours, and that's why they justify the cost. But databases make things more efficient. Again, that's my blockchain bias, but that seems like a system that is ripe for competition. Also, fractionalized ownership. We get into regulation concerns about securities and whatnot, but it also allows people to get more invested and own different aspects of a variety of things, which ultimately could provide utility. For example, if you own a fractionalized NFT, this NFT could pay yield based on NFT trading volume. And so it would be like an investment where you're earning interest on an NFT because you think it's going to accrue value. Or maybe a better example is like if you fractionalized an NFT that allowed you to take part on a golf course. If you own a fractionalized amount, you may be able to then use the golf course because that's what is required to use said golf course's ownership of this NFT. So there are a lot of utility being explored. And if neither of those two examples sound convincing, it's because people are still exploring it. There's tons of utility, tons of ideas and concepts being floated around, and people are investing in, right, one way or the other. So if you thought, well, that makes no sense, I'd rather invest in something else, that's perfectly fine. That's the beauty of blockchain, is that people are figuring out what works and what doesn't, and then people build off it because most of it's publicly sourced. Media, metaverse. I like the concept of metaverse. For example, what if you threw on a VR headset and you use a ZK proof to prove that you're above 18 years of age, which basically just ZK proof will demonstrate that you're above 18 without having to show your government ID. It just say true or false. So it's a true for me. And I start gambling at a casino, right? Maybe I start playing blackjack. It's $1 a hand. I lose a couple of hands, but then I hit a hot streak and I'm 5 in a row. Now my cards are on fire because I'm on a hot streak. And the casino's like, oh, this player David's on a hot streak. Let's send him a drink. Now I'm in my house with the VR headset on. How am I going to get a drink? Well, they could airdrop me an NFT that is effectively a coupon for Uber Eats to deliver me a drink from my closest bar or liquor store, or however you want to make that work. Now, there are some economies of scale that need to take place before that is reasonably functionable. But like once you start thinking, well, wow, I could be playing cards at the comfort of my house with real money in a legal, verified way and get a drink still, like that sounds pretty good to me. But that's what's being explored, is that the airdrop function and NFTs working as coupons and actual supplies to the average retail consumer in a way that you don't have to be someone that's enthusiastic about tech to understand what's going on. And then energy, lastly, is people transfer oil around the world, and in doing so you interact with other countries and other agents. And so there's always third-party risk where you have to trust someone around the world, and there's language barriers and whatnot. And so smart contracts will, again, bring it back to that trustless system. Smart contracts would help the automation flow, make sure products arrive on time and that they've actually been shipped out as instructed, using third-party data oracles. With that said, NFTs, I'll touch 2 topics on NFTs. So I'll talk about NFTs all day if you let me. NFTs are really cool, in my opinion, because it is digital ownership. I do fall into that camp. I don't think they're just JPEGs. Do all NFTs hold value? Absolutely not. I do think some are just cash grabs, but that is the nature with a young industry. What's cool about NFTs from a marketing perspective, so again, touching on a sector that you don't have to, love blockchain to understand, is that if I'm Coca-Cola and I sell you a can of Coke, right? And on the can of Coke, I have a QR code, you scan, you get an NFT of my Coca-Cola can, which maybe for the next month gives you a 50%, I'm just going to use extreme numbers, 50% discount on all Coca-Cola products. I hit the jackpot, right? So I scan it, get that NFT, it's on my phone. Now I'm scanning every time I go to like Target, I'm scanning it and get my Coca-Cola product 50% off. Well, someone, say on OpenSea, sees that I have this NFT and I'm getting 50% off. But really, I'm only buying 1 can of Coke a day. And so I'm saving, I don't know, $1 a day. Someone that buys a can of Coke every hour might be like, well, I'll pay you $50 for that can of Coke because I'll still earn more over the time I use it, right? And so people start bidding on this NFT. Again, you might be asking yourself, well, who cares if this NFT sells or whatever? Coca-Cola cares. And here's why. They can see, because blockchain is public information, they can see every wallet that has tried to buy this Coca-Cola NFT, which represents retail consumers wanting a product of theirs. So now they have a list of wallet addresses that they can airdrop a new NFT, get them coming buying their product. It allows them to market much more efficiently with relative public information. So they would have the wallet address, they would just wouldn't know who it is until they go in with their app, and now they can identify, oh, this person's wallet is with this app, and they go to this target. So then you can start bringing alternative data that's commonly used in the equity side with blockchain data to really become this marketing machine. That's just one aspect that isn't hyper specific to the technology stack, where you can start to begin to understand, wow, like these companies, these big, Fortune 500 companies are trying to get involved with. Automated smart contracts, touched on it. If anyone's ever had a corporate job, there's just so much that could be automated. I look forward to a lot of that in the future. And then MEV, maximum extractable value, previously known as minor extractable value. I added this in, it's a technical concept, but when I was looking at blockchain a couple of years ago, I thought MEV was like, if I was going to do a startup, that's the place I would look, because it's just so cool. There's a couple of different ways to do MEV, but at a high level, what it really means is when you are doing transactions on a blockchain, you have a limited amount of block space. So people put transactions in, and if there's too many transactions for the block, people like on Ethereum, you have to bid for the space on the block, which is where people start complaining about gas fees being too much. Basically, you tip the person that's confirming your transaction so that your transaction actually goes through. So what can happen though, and what's interesting is that, say I want to buy a Bitcoin for $20,000, right? So I place my transaction into the block, and someone else sees this transaction and goes, oh, David's buying a Bitcoin for $20,000. I can buy a Bitcoin on XYZ exchange for $19,900. I'm going to buy it, pay an extra $50 to make sure my transaction is before David's transaction in the block, and then sell it David that Bitcoin for $50. I'm simplifying a lot of this, but like at a very high level, that's how you could extract value that way. There's also a lot more technicality behind verifying transactions and organizing them in a way in the block space, but I'll leave it there. I think it's really cool and is ripe for opportunity. Any questions? Must be answering really efficiently for no questions. Glad to hear it. Yeah.
With the concept of maximum extractable value,
Yeah.
how do you take into account the transfer times for most exchanges, being that most of them require 3 blocks to proceed for your transaction to go through?
Yes. So a lot of the times it's done through smart contracts, so it only executes when both sides of the things are agreed. So a lot of times, like these flash bots is what they're called. They're going in and making arbitrage trades like the one I described. They'll go to a DEX or a decentralized exchange and be able to flip the coins that way to make the transaction go through. Now, yes, there is on the count of finality, there's always a chance for the transactions to be rewinded based on different chains being validated. So it's not ever like a riskless trade, if that's what you're getting at as well. Great question. In fact, I think someone recently made forget the number, it was a big number. Someone made a lot of I want to say a couple $1 million recently on an MEV trade. It was an arbitrage trade. And the only reason why I made my newsline is that then someone hacked their wallet that same day. So then they lost it. Or lost a chunk of that. I don't know the full details, but and that's another thing is especially in the cycle right now, blockchain digital assets is getting pummeled across news media, really news media, and some of your friends likely bought in at the peak and gotten crushed. I know I've gotten crushed a little bit as well. I'm not excluded from that, but these are the cycles when people are building. I lived through the 2017 peak and crash, I felt bad at the crash, but like, hey, that was the best time to be getting involved because people are building, developing NFTs, more DeFi strategies, explaining and understanding the technology was an amazing opportunity. And now I think this period is the next best opportunity because people that found it as a fad have left. They tried to make their quick riches and are out. And now the developers are left. So building now for the next bull cycle, possibly 2024 with the next Bitcoin happening, will, I think, reap benefits down the road. Yeah.
Do you think the halving scenario will trigger another bull cycle, given that this like asset class has never been tested under inflationary periods? And ever since the cycle, we're talking about Fed pumping in money and basically 0% interest rates.
Yeah, I've talked with lots of clients and we've explored questions like yours. So, hey, great, because I've got portfolio managers managing billions of dollars asking me questions like you. So great line of questioning. And the answer is when looking at historical data trends, I mean, historical data isn't always a predictive indicator of the future, but it's something to work with, right? So historically, Bitcoin halvings have been a great indicator for pumping. So my thesis is, yes, it could pump based on historical precedents. And also our Washington analyst has stated that regulation is likely to come for digital assets in 2023, realistically, even in the beginning of 2024. And I know based on having conversations with a variety of institutions, they're waiting to get in based on regulatory guidance. Long story short, if the government says these things are bad, these things are good, you can move forward on investing, tons of institutional money will come in, both public and private, to get involved. And it would be nice to have it line up with the Bitcoin happening in 2024. But to your point, Bitcoin's never gone through a bear market cycle. It's historically speaking, the past 12 years or so have been in a bull run in the equities market and the bond market. And so it is, like everyone says, unprecedented times. But on-chain metrics would suggest that adoption, although slowed compared to, say the beginning of this year, end of last year, is still up. People are still engaging on a variety of blockchains. NFT volume is up on a couple of different chains like Solana. And I'm optimistic on the technology. So, yeah.
I understand that blockchain can be put in automated contracts. The coupon, coupon example is fantastic. But when it comes to currency, like Bitcoin, I have a question. Generally, let's say you're buying stocks. You buy a stock, sell a stock. Even though the price of the stock is directly related to the demand of the stock, at some level, it based on the performance of the company, right? What about Bitcoin? It's mostly based on emotions and what I think. Any take on that?
Yes, I often get valuation questions about like exactly that, right? Like, how do you begin to evaluate a digital asset? I'm working on a valuation framework right now. I will touch on common practices recently have been, and Bitcoin's a hyper-specific scenario, so I'll focus on proof of stake, which are most coins, and then we can talk about Bitcoin for a moment. But for Ethereum, for example, free cash flow models. So a common modeling technique in TradFi to analyze the how much money you get free cash flow back to you for holding the asset, projecting it out over time, and then discounting it back at a certain percentage that allows you to see how much money the asset is worth. So things like Ethereum, you could do a free cash flow or DCF model to begin to evaluate it from one aspect. I think when I did the DCF model recently, it was like Ethereum's value was around 17 or 1800 a token. But that is all based on the proof of stake staking rewards, which is a function of number of people staked and network transaction fees. So there's already like multi-variables to include in that model. With that said, there's a lot to consider, right? Like I'll take Polygon, for example. If you look at Polygon and go like, okay, here's their transactions, here's their staking rewards, let's run with that. Well, that doesn't really take into the full consideration that they've recently had like 20 developments with huge Fortune 500 companies. They've had Mercedes, they've had Meta/Instagram come on. They've had a variety of large companies say like, hey, we're going to start looking at and engaging with your blockchain, right? So then how do you begin to evaluate that in a model that's strictly focused on a couple of rows in an Excel sheet? Lastly, and this does relate to Bitcoin, but can be applied to a bunch of other digital assets, are things like Metcalfe's law, which is a metric to analyze the reach of a network. People like to look at this and do different variations of Metcalfe's law. Stock to flow model was one that was popular up until it wasn't. It was looking accurate as far as pricing of Bitcoin, and then it stopped being accurate. But like, my point is that network effects for payment protocols like Bitcoin are a decent way to look. I would also look at developer activity. Development stacks are tough to quantify in a model, which is why I like to at least begin to look at machine learning aspects. Not that that isn't a huge buzzword that everyone talks about, but it helps identify trends and relations that humans normally wouldn't see in a traditional Excel sheet, which is very common on the TradFi side. Hopefully that begins to help. I don't have a silver bullet for you yet on like, this is the way I would analyze it, but those are some of the metrics I look at. Oh, I'd also add lastly, a tokenomics standpoint. That's something I always default to when like immediately looking at a protocol, is that if a token has an inflationary rate of 50% year over year, as an investor, you don't want your shares, your tokens diluted like you would want your equity diluted, right? So you have to begin to understand, okay, well, this is their inflation rate. Maybe they have a burn mechanism, so you have to backtrack that. And then from the tokens, where are those tokens being generated? Are they being sold off by the lab or the foundation to fund development? Are they being sold off to line their own pockets? Like, there are multiple questions that need to be answered. Or is the 50% from staking yields and getting DeFi pools to add liquidity for the protocol to grow, right? It's like a mix bag. You always have to usually dig a little deeper, which even leads me to like the whole Terra Luna fiasco, because that was even a split school of thought until it failed, was that you've got a protocol offering yields that aren't sustainable. So now that's collapsed, people are like, oh, well, obviously it's going to collapse. Fair. Then you can watch the treasury, which is awesome. Something unique to blockchain is that you can actually watch the amount of money in a smart contract as it goes up and down. But you could watch this treasury deplete over time, but also it was drawing in tons of users. And it's you could argue at a certain threshold of adoption on the chain, it might have been able to sustain itself. Granted, it would have to drop its rates a little lower, but you could argue as a marketing expense. And I've heard that argument before, and the reason why it's discussed even now is that other protocols are looking at deploying something similar. Maybe they change up a couple of things, but people are always developing, and so there's that aspect as well. Great question. CBDCs and the government, SWIFT. CBDCs, short for central bank digital currencies, are one of also hot contention, particularly because a lot of people don't want them. I guess before we dive in, I'll just state SWIFT, which is the network that most countries use for dealing with each other as it relates to finance, is linking different CBDC systems to ease the difficulty of cross-border transactions. What this really means is a variety of countries are looking at CBDCs, central bank digital currencies. They are either researching or are in beta testing, or have implemented some light version of CBDCs across their country. You can see this. There's a website called like cbdctracker.com or .gov. where you can see across the world how many are looking into what, but I guarantee you every country is looking into them. Reason being is a couple of them. One, outside of North America, most other countries are struggling with their currencies right now, whether it be inflationary pressure or otherwise, but a lot of the time it is inflationary pressure. And they are looking for a solution to their hyperinflation or economic woes, one of which could be a CBDC. Not saying that all will be implemented, but they're definitely being explored. And so knowing that a bunch of countries are exploring CBDCs, then you have to ask yourself, well, if I'm a smaller country without the resources to build my own CBDC, which toolkits exist currently that I can implement? Well, China is the only one with the digital yuan right now and actually implemented a full-blown CBDC. In part, they banned digital assets so it wouldn't compete with their CBDC amongst rolling power grids and things of that nature. So you got China's digital yuan, which is CBDC, where they could control the inflows of expenditure and transactions and monitor a variety of everything, all your life, whether you spend your money at Target or Walmart, they can cut you off saying that you can't spend any more at Target, or you can only spend X amount on shampoo or whatever it may be. That is a possible function of CBDCs if implemented incorrectly. So then let's talk about the United States here and North America, but we'll focus on the United States. I think the United States will build a CBDC, in part because they have to counteract China's digital yuan. If the only kit available to other countries right now is China's digital yuan, that is what will be used by other countries. But if the US builds one, at least we could hopefully build something that is more in line with our democratic ideals. That's why I think the US will build a CBDC, in addition to some of the research they put out and conversations that they've had in the Senate. Also, lots of investment is going into CBDCs, right? Because at the end of the day, there are payment rails that could be more efficient. Instead of if you transfer money from even like Venmo, right? It takes like 3 days to hit your checking account unless you pay extra money for it to be faster. Blockchain solves that. It settles almost instantaneously depending on the blockchain with some additional seconds for finality, right? So A, it's more efficient, and then B, I mean, like B, really, the government's put out multiple research papers over the past couple of years that say, hey, CBDCs are coming. We just got to figure out how to not create a run on banks. They've explicitly said in a paper that if they were to introduce a CBDC to the public now, that there'd almost be no reason for people to hold money with their current banks and there'd be a run on the banks. And that's because banks can't offer high yields for them. Like interest rates are fractional percentage points now. And so if you had a system where the government guaranteed your money in their own blockchain, people would adopt that. Now, there's of course risks and concerns about privacy, which is a very valid concern. But hopefully, if anyone is interested in building for the government, then you could introduce some of those safety measures. Questions? Great. And I was actually thinking about how you could build the CBDC in a kind of compliant way. And one would be just using ZK proofs, where you could basically verify who you are, that this wallet is yours, only if like a judge demanded that you validate it outside of just being able to show true or false, like this is my government ID when the government asks. Again, I'm glossing over a lot of the details, but it is possible. And then I also just add, since 2016, multiple banks have been partnering with governments and different blockchains to begin exploring proof of concept chains. Virtual assets and e-gaming, an opportunity for disruption. I'm a gamer, so I had to throw this one in. But it also is like a decent blend of like the metaverse aspect and NFTs. Cryptocurrencies hold a unique role in the e-gaming ecosystem, while traditional games end your turn your console off, your games linked to the blockchain are usable in the real world. What's fun and not everyone knows is that Vitalik, co-founder of Ethereum, actually started Ethereum in part due to World of Warcraft. He was playing World of Warcraft. He plays a certain character. The character on a patch where the game updates itself, his character got weaker. And so in doing so, he was pissed. He said he cried himself to sleep that night and then thought that centralized entities were evil. And so he went to build Ethereum with some other co-founders. So, and that's the power of gaming. But really, it does speak to the concept of when you play a game or you engage in an ecosystem, whether it's a metaverse or Minecraft or whatever it may be, you want to actually own what you're engaging with. And so in doing so, that's where the NFT kind of steps into play in representing like, oh, I own. And so this example is the Sandbox, a metaverse platform where I own the Sand token, which is the digital cryptocurrency, and I can go buy digital land. But on this digital land, I don't only have to play video games in this digital land, but I could actually build a business here. This business could be a video game, or it could be XYZ. For example, it could be I'm selling my own NFTs in this virtual land, and these NFTs are redeemable for a knitted hat, right? So people can come in to your plot of land, view it, see your knitted hat NFT, and be like, oh, I like that, I'll buy it, then burn it to be redeemed an NFT hat or a knittable hat in the real world. So that it works kind of like a storefront, but in a virtual space. Yeah, I glossed over a lot on that aspect, but in concept, it's there. But the point is that it's still a concept. A lot of people are figuring out how to maximize value from this, which again, just I think really highlights the opportunity in the space right now, where not everything is set and defined and you can kind of pave your own road. Maybe you don't like that concept. People have talked about building multiple like levels in a video game and charging people to play each level. I think the game would have to be phenomenal for me to continuously pay for that, but like I've spent money on worse things. So like it wouldn't surprise me. And then even on the collectibles side, again, I'm also into collectibles. So I've got some like PSA graded Pokemon cards, and people like sports cards. Like there's historical precedent to show that people like collecting things, whether it's coins, stamps, cards, whatever. NFT collectibles are a great opportunity to either speculate on collectibles or get involved and provide utility. Now here it demonstrates sports players' collectible cards, but there's also even things like a common example is like Ticketmaster. The reason why Ticketmaster wants to get involved with NFTs is pretty simple. They sell you a ticket for $50 and then you will go on the day of and sell it for $100. Ticketmaster does not get any additional proceeds when you sell it for double the price. However, with NFTs, when Ticketmaster issues an NFT ticket for, say, a baseball game, they sell it to you for $50. They get the $50 proceed, and then you sell it for $100. They can really set the amount that they get it as a kickback, but typically it's around 5% right now. So they will get 5% of your $100 sale. So now they just made $5 and the $50, right? And because of that, that's a 10% additional bonus in revenue for them on that one ticket. And then if that person then sells it for $300, right? Or even sells it for $20 after because they're selling it halfway through, they still make money. So it's a no-brainer for some of these companies to come in and be like, this is what we're doing. Lastly, I would just add, I know we're wrapping up on time here. I would just add that like, even if you disagree with a lot of this premise on blockchain, there's still amazing opportunity even on the app development side, right? So on the Ticketmaster example, right now, like MetaMask is the most common decentralized wallet for the average person. Most people won't bother with MetaMask because it's kind of complicated and scary when you're transferring money over. And you worry if you'll ever get it. So instead, building apps on phones becomes much more plausible for people to get in and get involved with blockchain without even knowing they're using blockchain on the back end. And that's the point that blockchain is supposed to get to. You don't want to have to explain the technology stack like you would now. You don't want to be like, oh yeah, my Facebook app runs on C++ majority. Like that doesn't make sense, right? So that's the way these things are transitioning. So even if you want to align yourself in a way where you're like, I have the best app for verifying NFTs in real life for the utility purpose behind them. For example, I have an app that does that called Token Proof, where you just scan a QR code and it lets you in to whatever event, and it verifies that your NFT is in your wallet, which has been super handy. Like it's very cool, but like these are the ideas that are being generated even now. So I'll leave it to questions, and but yeah, those are my thoughts on the space. Any questions? Yeah.
Yeah, I mean, so your last point, that's like the one thing that I think about is the accessibility aspect of a lot of this technology. And you touched on the apps and things of that sort. But it still seems a little too difficult though, even if you have played that, like you still need to like kind of understand it and to get people on board. It's not as easy as just like Facebook or whatever. Is it the time aspect? Like it's just gonna take people time to get used to this, or like just we need just the technology to be more streamlined?
I think it's a little both. For example, Solana, a blockchain that's coming out with the Solana phone. In their phone, they're going to have a native wallet built in. So you won't have to know, and I know this kind of spits in the face of not your keys, not your wallet mantra, but you won't have to know your seed phrase because it's just built into your phone. So now it's just acting like a wallet, like an Apple wallet on an iPhone would. So in that regard, then it becomes super easy to, if you build apps on top of the wallet integrated on the phone, then it just becomes like, oh, you have $50 of Bitcoin, well, you can spend it on these things. But yeah, some of it is like the on-ramps for businesses to accept Bitcoin, right? Because if I want to spend my $50 of Bitcoin at Target, like there has to be on-ramps and off-ramps for that. And treasury management for Target side, which is another thing that we didn't even touch on, was like these companies, big ones, are looking at treasury management because they know digital assets are coming. There's FX risk. So there's a lot of roles being developed and even discussed now in huge companies. Yeah.
Is there a difficulty for users having to use different networks for different applications? There being like no one main user wallet, and instead there being like multiple networks that shall remind remember your secret.
Absolutely. Oh yeah. So in space we call that interoperability, being able to move from one network to another. If you follow blockchain space news, all these hacks, a lot of these hacks that you hear about are bridges. What a bridge does is it acts as like the third party middle ground for A protocol to be able to transfer to B protocol. So they act as this middle ground for the interoperability to occur. But this leaves this bridge as a weak point in the security system to be hacked. And that's what happens a lot of the time, which is actually most of the time just a function of bad programming or unforeseen programming. But that, again, touches on my original points of like space is new. A lot of young developers, inexperienced developers are building applications that manage a lot of money. So there's still a lot of opportunity to like troubleshoot bugs or build better systems. Auditing was a really big one that I've had a couple of conferences in, where if you could read smart contracts and understand like where points of failure exist, I mean, that's a multi-million, probably multi-billion-dollar business in the next 5 years. I'll just expect a 1% equity cut is all. But again, like, you know, I hope at a minimum I've at least perked some interest, at least in some sector along the way. And yeah, I've got cards here. Please reach out because Cowen Digital is always looking for opportunities. And if it's not with Cowen Digital, Cowen's got an amazing investment banking team. And I would also just even add, like, maybe you want to go the VC route. We have relations with all the big shops and a lot of small shops, so we can figure something out to help. We're always in the business of helping people. So